On the morning of August 1st, 2012, the trading floors of the major American stock exchanges began behaving in ways that nobody could immediately explain. Shares in dozens of companies began moving simultaneously and erratically. Buy orders were flooding into the market at a speed and volume that was inconsistent with normal trading patterns. Prices spiked and fell in ways that made no sense given the absence of any news event that would justify the movement. Within 45 minutes, the chaos had subsided, but the damage had been done. A single firm, Knight Capital Group, one of the largest market makers in the United States at the time, had lost $440 million in 45 minutes. It was a loss so large and so sudden that it effectively ended the independent existence of the firm. Knight Capital was acquired by a competitor several months later at a price that reflected the devastation of what had happened that morning. The cause of the loss was not a rogue trader making unauthorized bets. It was not a sophisticated cyber attack by a foreign adversary. It was not a catastrophic macroeconomic event or a market dislocation of the kind that occasionally produces sudden and dramatic losses for financial firms. It was a software deployment error so straightforward and so preventable that the post-mortem analysis reads less like a financial tragedy than like a cautionary tale about organizational processes, communication failures, and the catastrophic consequences of human error in systems where the margin for error is effectively zero. The story of Knight Capital is the story of what happens when the gap between what an organization believes its systems are doing and what those systems are actually doing becomes large enough and goes undetected long enough to produce consequences that cannot be reversed. And the lessons it contains are not limited to financial technology firms or to the narrow domain of algorithmic trading. They are lessons about organizational communication, about the relationship between complexity and risk, and about the human tendency to assume that systems which have worked reliably in the past will continue to work reliably under conditions that are slightly but critically different from the conditions under which they were tested. Let us start with the background, because the technical details of what happened are inseparable from the organizational failures that allowed them to happen. Knight Capital Group was a market-making firm, meaning its business involved continuously buying and selling securities across thousands of different stocks and other instruments, profiting from the spread between the price at which it was willing to buy and the price at which it was willing to sell. This business required sophisticated technology because the speed at which modern financial markets operate means that decisions about what to buy and sell and at what prices must be made in fractions of a second across enormous numbers of simultaneous transactions. The algorithms that made these decisions were complex, numerous, and deeply interdependent in ways that made understanding the full behavior of the system under all possible conditions extremely difficult for any individual or team within the organization. In the days leading up to August 1st, 2012, Knight Capital was preparing to participate in a new trading program being launched by the New York Stock Exchange called the Retail Liquidity Program. Participating in this program required updating the trading software to incorporate new functionality. The update was deployed to Knight's trading servers in the days before the program launch. The deployment process required updating 8 separate trading servers with the new software. 7 of the 8 servers were updated correctly. The 8th was not. On that 8th server, an old piece of code that had been dormant in the system for years was accidentally reactivated by the deployment process. This old code, which had been used for a different purpose in a previous version of the system and was supposed to have been disabled, began executing when the market opened on August 1st and the retail liquidity program went live. The old code was designed for a function called market making, in which the firm would rapidly buy and sell small quantities of securities to facilitate trading for its clients. But the old code had been written for a different market environment and a different operational context, and when it was reactivated in the current system, it began doing something that nobody at Knight Capital intended or anticipated. It began buying enormous quantities of stock in hundreds of different companies and immediately selling those same stocks at lower prices, effectively executing a strategy that was guaranteed to lose money with every transaction it completed. The system was operating at the speed of modern algorithmic trading, meaning it was completing millions of transactions in the time it would take a human observer to read a single line of a trade confirmation. The losses were accumulating at a rate that was literally impossible to track in real time through normal monitoring systems. By the time the people responsible for overseeing the trading system realized that something was catastrophically wrong, the system had been operating for 45 minutes, and the losses had reached $440 million. Now here is where the organizational and communication dimensions of the story become the most instructive, because the technical error that caused the losses was serious, but not necessarily fatal on its own. What turned a serious technical error into a company-ending catastrophe was the series of organizational failures that prevented the error from being identified and stopped within minutes, rather than 45 minutes. The monitoring systems that were supposed to detect anomalous trading behavior and alert human operators generated alerts almost immediately after the errant code began executing. Those alerts were received by people within the organization, but the alerts were not interpreted correctly because the people receiving them did not have a complete enough understanding of what was happening in the system to connect the alerts to the underlying cause and take the specific action that would have stopped the losses. The alerts indicated that something was wrong. They did not clearly indicate what was wrong or what needed to be done to fix it. This is a communication and organizational design problem as much as it is a technical problem. The system was complex enough that the people monitoring it in real time did not have the contextual understanding necessary to interpret the information those monitors were producing in a way that enabled rapid and correct action. The gap between the information available and the understanding required to act on that information correctly was the organizational failure that turned 45 minutes of losses into $440 million instead of the much smaller number that would have resulted from stopping the system in the first few minutes. There's a second communication failure embedded in the story that is even more instructive than the monitoring failure. The deployment process that led to the error involved sending instructions to the technology staff responsible for updating the trading servers. Those instructions specified that 8 servers needed to be updated with the new software. The instructions were followed for 7 of the 8 servers and not followed for the 8th. The person or people responsible for the 8th server either did not receive the instructions clearly, did not understand that all 8 servers needed to be updated, or made an error in executing the update that was not caught by any verification process. This is a failure of communication and process design at the most basic level. A critical operational task was not completed correctly, and no verification mechanism existed that would have detected the incomplete completion before the consequences became irreversible. The assumption that the task had been completed correctly was built into the system's operation on August 1st. The verification that the assumption was correct was not built into any process that would have caught the error before trading began. In an organization where the margin for error is effectively zero, where a single uncorrected error can produce losses that threaten the survival of the firm in 45 minutes, the assumption that critical tasks have been completed correctly without any systematic verification of that assumption is an organizational design failure of the first order. But it is also an organizational design failure that is far more common than most organizations recognize, because the consequences of assumption-based operations are usually small enough to be absorbed and learned from rather than catastrophic enough to threaten the organization's survival. Knight Capital was unlucky in that the specific error that their assumption-based deployment process allowed to occur happened to be the one whose consequences were severe enough and rapid enough to be unrecoverable. Most organizations that operate with similar assumption-based processes about critical tasks get away with it most of the time and never confront the full potential cost of the organizational design failure. Knight Capital did not get away with it. The broader lesson about complexity and risk that this story illustrates is one of the most important and least understood dynamics in modern organizational life. As systems become more complex, the relationship between individual actions and system-level outcomes becomes less transparent and less predictable. The people operating within complex systems frequently cannot fully anticipate the consequences of their actions, because the consequences are mediated by too many interdependencies for any individual to track. This is not a failure of intelligence or diligence. It is a structural property of complex systems. The response to this structural property that actually works is not to hire smarter people or to demand greater diligence from the people already in the organization. It is to design systems and processes that do not depend on any individual fully understanding all of the consequences of their actions in order for the system to operate correctly. Redundant verification processes, clear and comprehensive monitoring with interpreted alerts rather than raw data, explicit confirmation requirements for critical tasks, circuit breakers that automatically halt operations when anomalous behavior is detected rather than relying on human observers to detect and interpret the anomaly and then take corrective action. These design principles are well understood in safety-critical industries like aviation and nuclear power, where the consequences of system failures have historically been severe enough to force the adoption of robust safety design practices over decades of painful learning. They are much less consistently applied in financial services, in technology, and in most other organizational contexts where the consequences of system failures are less immediately visible and less dramatically attributed to the specific organizational design failures that allowed them to occur. The email dimension of the Knight Capital story, which has given the story its popular framing as an event caused by a single email, is worth examining directly because the framing is both accurate and misleading simultaneously. An email was involved in the deployment process that led to the error. The communication about which servers needed to be updated and how they needed to be updated was conducted through email. The failure of that communication, meaning the failure to ensure that all 8 servers were correctly updated and that the completion of the update was verified, was a failure of the email-based process through which the deployment was managed. But attributing the $440 million loss to the email is like attributing a plane crash to the specific conversation the pilots had in the minutes before the incident that distracted them from a critical checklist item. The conversation was a proximate cause. The organizational design failure that made a single distracted moment capable of producing a crash was the deeper cause. Knight Capital did not lose $440 million because someone sent or failed to send an email correctly. It lost $440 million because its organizational processes for managing critical technology deployments were not designed to prevent single points of failure from producing catastrophic outcomes. The firm's survival depended on systems operating correctly across thousands of simultaneous transactions every second. The processes for ensuring those systems were correctly configured before trading began were not robust enough to guarantee that correctness under the normal range of human error that any organization should expect from its people. When the human error occurred, as human error always eventually does in any system that depends on humans, the consequences were irreversible. What does this story mean outside the narrow context of algorithmic trading and financial technology? The lessons are broadly applicable to any context where complex systems mediate the consequences of individual actions and where the margin for error is smaller than the organizational processes are designed to accommodate. First, the complexity of a system does not reduce the requirement for its reliable operation. It increases it. As systems become more complex, the potential consequences of errors within those systems frequently increase because errors can propagate through more interdependencies and produce more widespread effects before they are detected and corrected. The appropriate response to increasing system complexity is increasing the robustness of the processes for verifying that the system is operating correctly, not assuming that complexity is being managed adequately because it has been managed adequately in the past. Second, alerts and monitoring systems are only as valuable as the organizational capacity to interpret them correctly and act on them rapidly. A monitoring system that generates alerts that the people receiving them cannot interpret correctly in real time provides an illusion of oversight rather than actual oversight. The design of monitoring systems needs to account for the realistic interpretation capabilities of the people who will be receiving the alerts under the stress and time pressure of an operational emergency, not the theoretical interpretation capabilities of someone calmly reading the system documentation. Third, The assumption that critical tasks have been completed correctly is not a substitute for verification that they have been completed correctly. In any system where an uncompleted or incorrectly completed task can produce consequences that are severe enough to threaten the organization, verification processes need to be designed that make the completion and correctness of the task independently confirmable before the consequences of non-completion can materialize. $440 million lost in 45 minutes. A firm that had operated successfully for decades effectively destroyed in less than an hour. Not by a sophisticated adversary, not by an unforeseeable market event, by the interaction of a human error, a dormant piece of code, and organizational processes that were not designed to prevent that interaction from producing consequences that could not be reversed. The email that has given the story its popular name was a symptom of the organizational design failures that caused the loss, not the cause itself. Understanding the difference between the symptom and the cause is the beginning of applying the real lesson of the Knight Capital story to the organizations and systems you are part of. Next week on Quite Rich, I am covering the specific savings rate that the research says actually produces long-term wealth, why the number is different from what most financial advice suggests, and the framework for reaching it, even from a starting point of near zero savings. Subscribe so you do not miss it. New videos every Tuesday and Friday.